Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora, welcome back to another episode. So since the July RBNZ meeting, we've been talking about three key data points that we would be watching pretty carefully to really see where the Reserve Bank goes next, considering that they did pause in July and they wanted to see how things played out. The first one was the inflation data. We did an episode on that a couple weeks ago. But last week, we saw two of the remaining data pieces, the Kiwi jobs market and also the Reserve Bank survey of inflation expectations. Both came out pretty in favour of our call for lower rates. We're going to delve into those a bit more in this week's episode. But I want to say, and we're picking up from where we left off last episode, which was, I think Jarrod had some money on the table about what the unemployment rate was going to come out as. And he said, you know, whether or not you'd be here on Monday if it was correct, right, MJ? So you're here. So that sounds like it's a good sign. What happened to the labour market number?
I am here. My swipe card still works into the building. I think he's out celebrating because on balance, the labour market kind of came in as we expected. And actually on our forecast that we did in June, came in bang in line at 5.2%. Let's not talk about the actual day because it was slightly stronger, but I think last week's data report, the details were weak and it's what we were expecting. So I live to forecast another day.
I always believed in you, MJ. Don't worry.
Thank you.
So let's talk about the unemployment rate. It rose from 5.1 to 5.2%. We thought it might lift a bit higher to 5.3.
Yeah.
But as you said, the details were weaker. And even that, the reason why we didn't lift higher, what's happening under the surface there?
Yeah, so it went up to 5.2%. We were picking that it would maybe go up to 5.3%. The only reason why it didn't go up to that level is because the participation rate fell by a lot more than expected, and that in itself is a sign of a weak labour market. The fact that people are leaving the labour force because it's just not as attractive as it once was. That in itself is a sign of the weakness in the labour market.
Yeah, there's a lot of people either heading overseas or returning back to study. And so alongside the participation rate falling, which has been a common trend that we've seen in the past, I don't know how many labour market reports, something we haven't seen recently and is quite unusual to see is the labour force size also shrinking.
Yeah, it shrunk by 0.4% on the year. And you don't usually see the labour force shrink. I think it was the first time, if you exclude kind of COVID times, it was the last time since 2013, I believe, that it shrunk. So that tells you that, you know, our there's just no attraction to go to the labour force. So that labour force participation rate fell from 70.7 to 70.5, which is a 4-year low. So partly it's a correction from the high of around 72.4, but it is a lot weaker now.
Yeah, and I think as a whole, you know, looking outside of the headline unemployment rate, you can see that demand and appetite for labour just really isn't there. We're seeing employment is still going backwards. We're seeing firms are still restructuring, cutting headcount. I think employment contracted 0.1% over the quarter. And we had seen over the start of the year that maybe employment had kind of stabilised, but now we're back into seeing it contracting. And over the year, I think employment's down nearly 1%, which is about reminiscent of GFC levels. So that's definitely still showing that the labour market is actually still deteriorating.
Yeah, and those past prints you were talking about were actually revised down. So we had, I think, a gain over the March quarter that was revised down to being flat. This quarter, or the quarter just being June quarter, it fell. And on the year, it's down. Employment is down almost 1%, which again is quite a big number. Just tells you how much there's just no demand for labour right now, and that fall in the participation rate is just basically saying that supply is meeting that weakness in demand. So we're seeing that play through.
Yeah, and something interesting with that fall in employment, we're seeing it's the full-time workforce that continues to shrink the fastest. I think that's, you know, compared to this time last year, there's 33K less jobs in the full-time workforce. The part-time workforce, interestingly, we had seen it kind of expand over the recent quarters past year, just as, people who are, looking for more hours, perhaps losing their full-time workforce, moving into the part-time workforce, that's grown. But we're actually starting to see that maybe, showing some cracks of weakness. And we saw part-time employment was down 1.5% over the quarter alone. So probably struggling to absorb that extra shift of labour.
Yeah, and I think that's really reflective of a kind of tentative economic recovery or just weak economic times when you see most of that labour, if there's any employment growth, that's in that part-time employment because it's reduced hours. It's not the full-time workforce that typically rises during times of economic strength. So that is the themes that we're seeing in the labour market is just reflective of a weak economy, isn't it? And I think so we had that sort of full-time, part-time split, but you're also looking to other demographic splits of that employment. What else did you see?
Yeah, it's kind of similar themes as we've probably mentioned a couple times now when looking at the labour market, that youth continue to sort of bear the brunt of job losses. So I think, of the 48K job losses over the year total, 30% of those were in the age group for 15 to 24 years old, which is really crazy for me to hear now because I actually don't fall into that category anymore. Since this labour market report, when I was looking at the data, I was like, wait, that's not even my age group anymore. So I feel a bit old. But yeah, we are still seeing the younger cohorts, losing those jobs. If you actually split up the high schoolers to the, I guess, uni grads, it's actually those high school 15 to 19 that are really seeing the bulk of the job losses there. I think there was 13,500 job losses over the past year in that space. So encouragingly, we have seen a big shift. I think we saw quite a big increase in youth heading into education. I think it was up 5% over the year. Stats NZ did say that a big driver in that lift was from youth already not in the labour force. But I think that still kind of reflects the challenges that are in the labour market today. Young people are probably hearing that it's a really tough climate in the jobs market. So they're thinking, all right, I'm not even going to head straight into the jobs market. I'm going to go towards education, upskilling, things like that.
Yeah, I think it was a pretty soft report. So to see a kind of bright side that they're going either going back to school or entering school and just bypassing employment for now, I think it's kind of a good thing. They'll, as you say, they'll upskill and they'll re-enter the job market with, with better prospects, better job prospects, hopefully by then. But I think that's one bright spot of the report.
Yeah, absolutely. I think especially if you think about the past couple of years, back when we were coming out of COVID lockdowns and the labour market was so attractive, it was really pulling those young people off the sidelines. Wages were pretty attractive. There was a really high demand for workers. And I think that really did see that lift for high schoolers, young people moving straight into the labour force as opposed to going into alternative pathways back into education, whereas that's starting to reverse now a bit.
Yeah. So in the same way that we had a very strong labour market, it was pulling young people into the workforce, and it was also pulling kind of soon to be retirees off the sidelines as well. Are we kind of seeing a reverse of that as well?
Yeah, not to the same extent as young people, but we are seeing that shift of, early retirement or, I guess not that same pull of older people back into the labour force.
Yeah, so it's just a bit of a correction, but just showing how weak the labour force is. Alongside that fall in full-time employment, we're also seeing that hours worked were down. I think on the June quarter, it was the 6th straight quarter of hours being in decline. That obviously has some impact for our growth expectations for this one. It's not looking very pretty.
No, it's looking pretty ugly. I think, I remember at the start of the year or a couple months ago, Jarrod actually asking, what do we think the GDP print is going to be for the June quarter? And at that stage, it was still too early to say whether it would be a negative number. I think he was specifically asking whether we thought it was going to be another contraction. And I remember saying, at the moment, probably just a weak lift in activity.
Yeah.
But actually since then, we've seen, a number of data prints, whether it's your manufacturing PMI, your services PMI, and now your total hours worked down, actually pointing quite obviously to another contraction over the June quarter. And we look at that because we see there's a beautiful chart. We'll put it up right now where the number of total hours worked does follow your GDP, and we've just continued to see that decline. It's pretty reminiscent to GFC type times as well.
Yeah.
So that's not looking good for the June quarter, alongside all the other evidence that points to a contraction over the June quarter, which, again, just really tells you the labour market is still deteriorating, hasn't stabilised yet. Activity is going backwards, and we'd need, rate cuts to really get things going.
Yeah. And I think on the year, what is it, 2.6% down hours worked, and there is that correlation with actual economic activity. So it looks like that June quarter may actually be a contraction in output. But yeah, I guess the labour market, so the headline rate came in at 5.2%. That looks like it's better than expected. But if you look at something called the underutilization rate, which is kind of your broader measure of labour market capacity or untapped labour market capacity, that tells you, I think, the better story. That rose to 12.8%, which is, I think, a five-year high. It just tells you how there's a lot of slack in the labour market.
Yeah, which feeds through onto your wages as well, right? That slack in the labour market, we should also point out, is disinflationary. And we're seeing that come through in the wage growth section of the report. I think wages are up by the smallest amount in 4 years at 2.3%. So you can really see that pressure's coming off, which is, good for the inflation outlook. I think it continues to reinforce that, we're not at risk of this temporary spike in inflation that we're seeing to actually stick around. It is just that temporary spike. But obviously a bit of a challenge right now with the cost of living crisis is really still persisting. We've got annual headline inflation running at 2.7% while your wage growth is at 2.3%.
Yeah, it's still tough. I mean, would be remiss to say that this is not the Phillips curve kind of in action when you've got unemployment high, wage growth and overall inflation is kind of heading lower. So that's a Phillips curve in action. But on that inflation expectations we were talking about at the beginning, how we got the latest round for that. It looked like a pretty good report, at least in terms of inflation expectations being contained.
Yeah, because we've talked about it on the show a couple times. There's a really good episode. I can't remember what the name of it was, but we looked at, the power and the magic of inflation expectations and actual inflation. So if you need a reminder on how that relationship works, definitely check that out. But basically what we normally see is that inflation expectations tend to follow actual inflation. And so given that we did see that rise in actual inflation over the June quarter, there was a bit of fear that we would see a bit of a lift in inflation expectations. We know that the Reserve Bank have been a little bit worried about the rise in inflation expectations. If we recall back to the May MPS, when we had that really strange, unusual 5-1 dissenting vote on whether to keep the cash rate unchanged or cut. We heard that the argument for that was because of this rise in inflation expectations. So there was a bit of weight going into that, sort of expecting that release to come out. And actually it was, as you said, pretty good news. We saw actually the 1 year and the 2 year ahead measures, so where you expect inflation will be in 1 year's time, 2 years' time, those actually dropped. I think the 1 year ahead is now at 2.37%, 2 year at 2.28%. So really comfortably within the Reserve Bank's 1 to 3% target band, and really shows you, inflation expectations are remaining anchored.
Yeah, I think with the way that this has gone, the survey, it really, I think the Reserve Bank should feel comfortable looking through this rise in inflation expectations. We won't see that kind of persistence as you're talking about. The second round effects of a rise in inflation look kind of contained for now, which is good news, because if it had headed the other way, I think it would have been a bit more uncertain as to what they'll do. But all the data is kind of pointing to basically lower interest rates, right? That door is open for a rate cut.
Yeah, absolutely. I think if you look at market pricing this morning, I think there was about, 23 basis points priced in for their for a rate cut next week at their meeting, which is about 92% chance of a rate cut. It's basically baked into the cake. I think what we need to see now, and what this data still tells us, is that actually we still need even lower rates. There's still not quite enough priced in, and also probably not soon enough priced into the market just yet for that. But we're hoping, with the NPS, we might see some shifts there.
Yeah, because really the concern here is just how weak the growth outlook is. And the Reserve Bank's mandate is on inflation and targeting 2% in the medium term. But when you've got a growth outlook that's really weak, it means that you've got potentially a softer inflation outlook than what they probably thought in May. So we'll be interested to see that August NPS, because we'll get a fresh track, we'll get fresh forecasts and see how their thinking's evolved since they basically paused in July. So we're just waiting for that day, it seems.
Yeah, and just touching on that, exactly, you've got a weaker outlook, which does mean, softer inflationary pressures in the medium term. And I think we can really, be quite confident in that as well. If you look at the labour market with all that spare capacity still there, and then also the fact that, firms' pricing power, as we've talked about a couple of times as well, that it's basically evaporating. Firms are actually looking at reducing prices in the current quarter that we're in. You don't usually see that unless you're in this recessionary environment. So all in all, it is those factors of a weak growth outlook, and actually the fact that inflation does remain contained, really opening that door up.
Yeah. Okay, I think that's it for this episode. It's probably a lot of numbers that we just ran through this time around, but all to say that the labour market is weak. The headline may have looked better, but beneath the bonnet, it was quite a weak report. There's just no demand for labour, and supply is basically responding to that, people leaving the labour force. That just tells you, if you put that weak jobs report against inflation expectations being well contained, inflation itself having underlying price pressures be quite weak, all of that data, as we said in the last one, the stars are aligning for a rate cut from the Reserve Bank at its August meeting, and there is clearly a need to actually produce a bit more stimulus into the economy as well, so getting that cash rate below 3%. But that's it from us this week. So please follow and subscribe.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.